So, right. Thanks, students. Thanks, Ahmad Jafar, Wafa. That remind me about the recording. I always going to forget about these things. So let's see. We moved on the major finance statements. We studied about the accounting question, where is asset equal to capital plus liability, right? And next one, we looked at accounting concepts and principles. We looked at 8 of kind of accounting concepts, and we have a given determination of these concepts. What is the business entity concept? What is the cost concept, and so on, right? So now we are going to move on the planning and control. Planning and control in the accounting and the finance. So, in any organization, we have 2 types of accounting, which is first financial accounting and the management accounting. So, financial accounting is divided for 2 kinds of accounting, for finance account and the product costing. And the management account itself is divided on the planning and control. And here is the plan, control, and product costing. All are cost accounting. Represents to us the cost accounting. You have to just remember that plan control includes the cost account, which includes the planning, control, and product costing. So what is the plan itself? The plan is setting the goals and ways to achieve them, right? And the plan in its most basic form involves the determination of 2 things: the goals for an organization and the way to achieve the goals. The manager should not only know where it hopes to be or what it hopes to accomplish during the future period, but should also know how it expects to reach these ends. This is the plan and control. So plan should take the place at all levels within the organization. We can meet the plan in any field, right? Even the small sub-unit of an organization is involved in the plan process, and its plans must be coordinated with the plans of the overall organizations. And the tool used by management accountant to assist it. So, as we finance, we use the budget to plan to make a plan. The budget, this is like a special forum or a special instrument, like a tool in any organization, which includes the planning the capital of the organizations. And accounts use the budget to help the managers to plan. So what is the budget? The budget is the formal quantitative expression of the goals set by the management. And there are a number of different types of budgets. We have in the accounting instance, we have the master budget, we have functional budgets, we have a relevant cost budget for special decisions, and capital budgeting. What is let's see on each other on the determination of the master budget. So it provides the management with an array of the plans for all operations, like sales, production, purchasing, and financing. This is the master budget. Master like a general budget, which includes the sales, production, and so on. And the organizations are often faced with the need to purchase additional property, plant, and equipment. And capital budgeting analysis offers several methods to assist the management in making these decisions. So here is the capital budgeting. It helps to accounts to analyze, to make in the making decision to buy property, any property, to buy plant or equipment. This we call the capital budgeting. So, And after the plan process has been completed, that is goals and the ways to achieve them have been determined, the next things to do is to put the plans to work, right? So first we have a plan, right? We set the goals, and to achieve these goals, we have to work itself, we have to make something, we have to do a business, right? And the next one, and once those plans start to work, it's necessary to monitor the operation, to see if they are achieving what they are supposed to. So after the planning and doing the business, we always must to monitor the business, control, to see what we have, what we got actually, what we have expected in the future, and what we get at the present time. In other words, managers need to exert some control over the operations they manage. I think you are agree with me that all business, all fields needs control. So let's see on the control in detail. So controlling involves 4 things. The putting the plan to work. The first is that we put the plan, any plan to work, right? And the second is observing those plans at work and gathering the information on how they are performing. It's always like this. We are observing the plans, how they are working, we making some feedback. And the information collected to assess the performance of the organization reaching its goals is often feedback, right? I just told you. So we are observing, we're collecting some information on how the things are doing, how the business is actually going on. And then we're collecting the feedback from this. It's like, for example, you are going to market any product. So the first we have putting the plan to work. So we put the product on the market. Yes, we are marketing, we are PRing that product. And then we are observing how the customers are buying product, how they like that product, how our sales are increasing. And after that, here is I'm going to show you the feedback. We're collecting feedback from customers, right? We have like some questions, review questions like, do they like this product? How they like this product? Maybe they can suggest something to improve this product, and so on. This is called feedback. And next one, if the plans are not on track toward attaining the intended goals as determined by the feedback, management must determine what action is necessary to get those plans back on track. So we have got some feedback from customers, right? And we have determined that some customers, for example, 30% of the customers, they don't like actually the product. Maybe they are not satisfied with the product, with the price, or with the qualitative with the quality of the products. And then we have to determine what we can do to improve the product, what we should do. So, and the planning finance includes this kind of questions: how to improve the product, to increase the sales, right? So, and the next step is taking action to remedy whatever may have caused the plans to go astray. That means, this sentence means that we have to take action to change customers' view on that product. We have improved or changed our product, and that our plans must go astray. Must go in the future. Must go away, and we have to make some actions to make our plans to be prepared, actually, to be done what we have expected. This is the 4th step of the planning and control. I think these are the things are very familiar for you if you are working in marketing department or sales department. So let's move to the next one. So control requires implementation, the feedback and corrective action that we have talked about, the 4 steps. Implementation to put the action to put the action on the work, right? And feedback, collect the feedback from the customers, and corrective action to make a change on the product if the customers are unsatisfied with the product. So, and the accounts use the performance reports to help managers control. So how it actually goes? The account, they are not sales, right? They are not working with the customers. They are sitting on their department, and they can see on their balance sheet statements, they can see on the numbers only, figures only. So if the sales are decreasing, of course, they see that the expected sales are not held, and they must to help to sales department to change this process, to change, to increase the sales, the overall organization's, what they called, the goals one. So, and they can't, they help to managers control how the sales going on, increasing or decreasing, how customers like the product. They see on the figures, on the sales, on the purchasing, for example, on the sales and purchasing numbers. This we can see on the balance sheet. Any accountants who is a good accountant, he or she just can check like income statement from any organization and can determine that these organizations are working good or not. The sales are increasing by year or not. They can see actually the picture of the overall picture of the organization in the market. Do you understand me? I hope so. So let's see the next one. So we have a relation of the. So let's see on the relationship on the plan and control. So it's like they're just given a statement like a plan without the control is like a ship without the rudder, and the control without plans is like a ship without the compass. This is the right things. Just given statements for you to understand more detail what is the plan and control. Next one. So how the progression is going on in the plan and control. Let's see. Plan, as I told you, we set the goals first, right? We determine the actions. So I'm going to recall. So first is we set the goals, determine the actions, and put the actions to work. You have to remember these things. We gather feedback, right? We collect the feedback from customers. We evaluate the feedback. Why is the situation becomes like this? Why it happens like why we got what we have but not what we have expected, and we take a correct actions. We take a correct actions. So, and this is the set goals and the determine action is the planning process, and the control include the from put actions to work under the take correct actions. So let's see. In the accounts and the finance, we have a statement like a true and fair view. What is actually? So the Companies Act 1985, this is by Britain, by UK Companies Act, true and fair view requirement. Another foundation of the authority of HCB standards is the requirement in section 226, 227 Companies Act 1985. So that accounts must give a true and fair view of the state of affairs of the company and, if appropriate, the group of which it's part. That means all accounts in the organization, they have to give a true and fair view of the company in their income statements, in their balance sheet, in their accounts formats. That means how much we got the sales, how much we get the revenue or loss. We must to show it in our income statements. Means true and fair. What we have, we show it. What we do not have, we show it also. This is ASBA, is accounting standards of the business standards. So let's see the next one. True and fair view is the correct statement of company's financial position as shown in its accounts and confirmed by its auditors. So this is the fair view is a statement. Is a company must show its original financial positions in their accounts, actually, in their statements. So let's see the next one. And we have fundamental concepts. So do you remember on the last class we have looked on the accounting conventions and concepts? We looked at the 8 kinds of accounting principles. Here we are looking on the 4 of them. The 4 fundamental concepts that normally form the cornerstones of the true and fair view. This is a going concern. As you remember, the concept used for valuing the assets and liabilities on the basis that activities will continue uncertain for the foreseeable future, and that there is therefore no need to use liquidation valuation principle. The going concept that means that any organization business will continue in the future its business. The next one, the accruals concept, which subject to prudence, brings the relevant transaction into the same period of account without regard to actual days of receipt and payment. And the consistency concept of treating like items like within the accounts and from one year to next year. This consistent, we will continue our business consistent. All these kind of concepts we looked already in the accounting concepts and accounting conventions. And the prudence one is the concept of making the provision for all actual and probably liabilities, but only including the assets as income and receipts when they are definitely visible. That means we have to make a provision for all actual our liabilities. We have some kind of credits, right? For example, the credits like some debts. And we have to make the provision for all these our liabilities. So here it's assumed that accounts intend to show a true and fair view. It's based on the comply with these 4 concepts unless the accounting policy declared in the note to the account specifically excludes one or of them. So true and fair view means all those we have 4 kind of concepts. Or in totally we have 8 kind of concepts, shows the company's financial positions at the current moment. Yes, I know I am too fast. I am so sorry, but we have a huge material to study for today, to learn for today. And this is all theoretical things that I have shown for you right now. Yes, right. And next part will be the exercises, and that more is difficulties, and we have to understand how to make an exercise. So right now we are just finished our chapter number 1, introduction to. We just finished the introduction to accounting and finance. Have you seen that we have a huge presentation for this class? It's 42 slides only. So and as you remember, in last class we got accounting equations class, and we have studied about the assets. What is about the determination of the asset, liability, and capital, right? And now we are going to see the transactions. How we make a transaction in the accounting. So in the first chapter, here is most of these things are theoretical. You can just read yourself and understand. But later in the accounting skills, we are going to see the transactions. We are going to see what is the double entry. And we will do some exercises, and this is really very important. And it's hard to explain actually, and hard to understand. And I try to explain as I can clearly, and I hope you will understand it. So I have some questions. So I have a question asking me understand what's a going concern concept. So going concern concept here is, oh sorry. The going concern concept means, here is just one time, I'm going to share you the last presentation, and we have a full description of the going concern concepts. You remember we on the last class we had accounting concept and convention slides, the presentation. Here is the assumption of going concern. According to this assumption, an entity is assumed to continue to exist and operate in the future. So that means any organization is when they do accounting, when they do report on the income statement and balance sheet, they always have some balance on the next year. They are not closing their accounts. And that means they are assumed to continue to exist in the future, to work, to make a business in the future. This is going concern means. So, I have a question from Mr. Navid Miahel. Sorry if I spelled wrong. What is liquidation valuation? Liquidation means when the company is bankrupt, are closing. Bankrupt and liquidation means going to sell what it has, what it had, its last product. Liquidation means bankrupt. So means going concern means company will continue in the future. It won't be bankrupt, it won't be liquidated, and will continue the business. So I have a question, what is the difference between accounting and the bookkeeping? Mr. Kaysharov is same. Accounting and bookkeeping is the same, just synonym words only. So let's move to the next. Let's see on the transactions, how we analyze transactions in the accounting. So here is, we have an accounting equation, as you remember, that assets equal to liability plus capital, right? The capital of the company is what the shareholders invest in the company, and liabilities of the company, for example, they have some loan or credit in the bank. All total show us the assets. Assets includes, as you remember, the equipment, cash, property, plant, land, and so on. So, and transaction. Let's see, the number one transaction. RIN is the name of the person. The RIN invested the cash of 30,000 into RIN's cable service. This is just an example. You see, here is the given 4 kinds of statement, and after that we will look how they must be transact in the accounting. How we show in the accounting their transactions. The second is a purchase a piece of land valued at 20,000. The business paid cash 5,000 and the balance is financed by the bank loan. And third is the purchase office supplies valued at 2,700 on credit. And fourth is the receipt revenue from consultancy services provided to customers. The customer paid 15,000 in cash. So I have here is a question: what is the liabilities, debit or credit? For these things, right now we will learn about this. Just wait for a while. So let's see, we have a 4 kind of transactions, right? And next slide shows the solutions, how we implement this kind of transaction in the accounting. You see, the first one, the transaction, 30,000. Why is in the asset is a 13,000? You remember we have a accounting equation that asset equal to liability plus owners. So first we had reinvested 30,000 cash in the company, and we show that the owner's equity equal to 30,000, right? The capital of the RIN's capital. So we put on the capital, this is 30,000. The next transaction, and later on the assets, we have no liability yet. We have a 30,000 on capital only. And 30,000 plus, here is 0 for the moment. It will be assets equal to 30,000, right? And here is on the transaction balance, we show that we have a cash 30,000. This is the same as here is the capital. Maybe we have some cash, maybe we have a land, any figures. And the second transaction shows us minus 5,000 plus 20,000. What that means? So let's go to back. The second transaction, they purchased a piece of land valued at 20,000. So the man, he purchased a land which is cost 20,000, right? And we show in the assets, this is what we have actually. Asset plus 20,000. He purchased a land. Here, as you see, is increase. Our assets right now increases 15,000 for 20,000. And go back to the second one. The business paid cash, and we paid the cash at 5,000. Which is financed by the bank. So this is our cost. Why is minus 5,000? We have paid the cash to the bank at 5,000, right? Before we got the 30,000. Now we paid from 30,000 5,000. Here it means 30 minus 5 will be the balance will be 25,000. And the land which is we purchased is a 20,000 remains. Do you agree with me with these things? Who do understand? Who didn't understand these statements? And then we will continue. Just let me know. So you remember, reinvested 30,000 in the cash, right? It's capital. And then he paid to the bank 5,000. So it means minus 5,000 from the 30,000. And the balance will be 25,000. And later he bought the land which cost 20,000. It shows also assets. Assets shows our cash, our land, property, and so on. Yes, clear, right? Then, what is the 15,000? Let's back. We have this is, you see, the transaction number 4. We have received revenue from consultancy services provided to customer, and the customer paid 15,000 in cash. I think we have missed some transactions because let's see, we have here is we already have plus 15,000. This is the cash, and this is 15,000. Our liability shows. Yes, yes, right. We have missed some transactions. Yes, Mr. Bark, you're right. This 15,000. Let's back. We have here is we have a 13 plus, right? We bought the land 20,000. The business paid cash 5,000, and the purchase office supplies at 2,700. So here is liability. Liability shows 15,000. This means just little. Just wait for a while. Somebody will. Yes, our sales right now is 45,000 because the 15,000 plus 45. So here is we must have a equation between the assets and liability and capital, right? Here is we have this one. We have 45,000 on the assets, and we have 45,000 on the liability plus capital. So it's right. I do understand right now. This is here 15,000 means that we have a liability. That means the customer must pay to us 15,000, and later we show in the assets that 15,000, right? And transaction number 4, the customer paid is 15 in cash. So let's see. Yeah, this is strange. This is. I think in the exercise this transaction has missed on the 15,000 on liability. Let's give it that is has given by the bank, is loaned by the bank, okay, right? Because we will confuse them. So and let's move to the next one. So you remember we have a balance 25,000 in cash plus 20,000 land. And here is, on the owner's equity, we have a 30,000 plus 15, which is loaned by bank. And transaction number 3 is, you see the transaction number 3 show the purchase office supplies worth to 2,700, so on credit. So we bought some equipment for 2,700, and we show in the supplies. Here is, and also we show in the liabilities because we haven't paid, but we have taken in credit. You see why we show in the two kind of sides? Because we haven't paid this cash, we have taken in the credit. And then let's see the transaction number 4. Let's back. Here is the receipt revenue from. So we have received some revenue at 15,000 in cash. So we will pass it to the cash for 25,000. Will be in total will be 40,000 plus land. We have a 20,000 plus. We bought the equipment for 2,700, and equal to liability we have a 15,000 which we loaned from the bank. We have a 2,700 which we haven't paid to the we haven't paid for the equipment. We have taken on the credit, and we have on equity. Here is 30,000 plus 15 service revenue, so it will be equal to 45,000. So, and right here you can see the balance that the left hand side, the assets will equal be for right hand on liability plus owner's equity. Yes, and here is Mr. Barr says the 60,000 should be at the both sides, but we have you forgot about the supplies that equipment have bought for 2,700, and that we haven't paid it on the credit. So we have you just lost these two figures. But here is there will be in equal the assets and equal to liability and capital plus capital, and in total will be here is 62,700. Yes, right? So so I hope you have answered these transactions. We have just one mistake about the 15,000, which is, I think it's lost in the exercise. This is 15,000 which is loaned by the bank. It haven't showed in the exercise, and after all rest of them are right. So right now we have a quick review questions. First, determine the appropriate amount is a spaces mark. And the second one, you see the state the effect of the following transaction on the asset, liability, and ownership, and example is shown in the transaction A. So let's do the first one. Who wants to give? I think this is a simple one. Who wants to give the answer for the first exercise? Like assets is equal to 84,000, and liability is, we have no figure, and ownership is 38,000. If anyone wants to have a calculation, can calculate. So I have my answers also. Yes, right, 46,000. So what is about the exercise B? $72,000 liability plus owner security 82,000, and assets total will be 100,000, right? And then what about the exercise number C? So we have a 50,000 liability. How much would be owner security? No, it will be 75,000 on the owner's equity. Let's see the C, exercise C. 50,000 plus 75,000 will be 125,000, right? So the answer is for C is 75,000. How do you, Mr. Kaisha, Mr. Bara, how do you calculate the 66,000? This is, yes, right. Okay, thanks. So, okay, for B. So let's see the next one. The state the effects of the following transaction on the asset liability and owner's equity. So the transaction, the pay debts to supplier, the effect, assets will decrease and liabilities decrease. What about the B, the purchase office equipment by cash? Any answer who can do this exercise? So if we purchase office equipment, we have make some cost, right? By cash. So who wants to write the effect, how it shows? What is the answer? So if we purchase office equipment by cash, our assets will decrease. Why? Because the cash is assets. Yes, Mr. Kaisharov, right. Assets will decrease. And then, and what about the capital? Capital also would be decreased, right? Because the cash also as a capital. Yes, right. Mr. Navid gives us true answer. Assets will decrease and capital decrease, right? Let's see on the C. The owner took cash from the business for personal use. Mr. Barak, asset will decrease because the cash is asset. The capital, the cash actually will be under capital and under assets, and will decrease because we have paid for the equipment. So the true answer was from the Mr. Navid, and let's see the exercise C. So right now I'm going to share with you my answers. Just give me a second. Sorry. Share. Where is it? Just a moment. Share files. Answer. So here is my answer for the questions. And let's see, the B is assets is decreased and capital is decreased, right? And exercise 9, number C, owner took cash from the business for personal use. So the owner took the cash from the personal use. Do you remember about the concept, the business entity, that where we talk about the business budget is separate from owner's budget? And here is the assets will decrease because we have taken the cash from, because the owner had taken the cash from the organization. And capital also will be decreased because he has taken the cash which is invested in the company. Do you agree with me? Who are thinking same as me? Yes, right? It's clear, right? So you must understand these transactions, how we do in accounting, because this is the basic things that we do understand. Yes, it is the same. The answer for B and C are same, as you see. So right now we have finished our first chapter. We have finished our first chapter. So let's move to the next one. I'm going to share with you chapter number 2. Right now we will learn about double entry and trial balance. So can you see the slides? The presentation on the introduction to double entry and preparation of the trial balance. So topic and the structure of the lesson. What is a double entry posting? The balancing of account, the trial balance, and errors on not disclosed in the trial balance. So at the end of this, you should be able to post transaction to ledger, to close the accounts, and the prepared trial balance. So key terms you must be able to use is the ledger, debit and credit, and trial balance. So let's see to the introduction. So after saying how to analyze transactions, you remember, right? 5 minutes before we have analyzed the transactions. And we will now learn about the recording. And recording is the most important step in accounting for business entity. However, before recording, we must identify the event that have occurred. Only event that occurred to the business entity will be recorded in the entity's book. So not all events are transactions. For example, recruitment of staff. Although it will affect the entity economically, this event is not considered a transaction. So I think you do understand that not all events seems like transactions, but all events which affect the business are transactions. So right now we are going to learn about the recording. So here is given some definition of accounting. This is a process of identifying, measuring, and communicating economic information to users of the information to permit informed judgments and decision making. This we learned about in the first chapter, and it's discipline which provides the financial and other information essential to the efficient conduct and evaluation of the activities of an organizations. Just given the statement for you to understand in detail what's the accounting itself. So let's see the account for double entry. This is very important. So each account should be shown on separate page in the accounting books. So this is the layout of the page of an accounts book. So the title of account written here, you see, and on the left-hand side of the page we have a debit side. And the right-hand side of the page, we have a credit side. So you must remember, the left is debit, the right is credit side. This always remains same. So rules for double entry bookkeeping. You see, we have some of you asking about me accounting and bookkeeping are same or not. They are same. You see, here is given a statement like a bookkeeping. Rules for double entry bookkeeping or accounting. So here is the rules for double entry bookkeeping are outlined in the following table. So we have accounts. You remember you have assets, liabilities, and capital. And to record them, they will increase or decrease in how we show in the accounts. So if assets increase, we show in the debit. Debit means on the left side, right? If assets will decrease, we show in the credit on the right hand side. Then liabilities. If liabilities will increase, we show on the credit side, on the right hand side. You see, it's a different from the assets. And if it will decrease, we show on the debit side, on the left hand side. And capital. If it increased, we show on the credit side. If it decreased, we show on the debit side. As you can see, the liability and the capital are same. Same shows in the credit and the debit. You see, if liabilities and capital increases, we show on the credit side, If it decreases, we show on the debit side, right? Only assets are different, would be changed, vice versa. You see? So this is rules for double entry. This one, you have to take on your head, you have to take on your mind, and remember always these rules of the bookkeeping. Let's see the next one. So transaction account is the two-side account layout that has been used to apply and show double entry bookkeeping. So any transaction must be shown in the double entry account. You see? Here is assets. If it increase, you remember we show on the debit side. On the left side, debit. If it decrease, we show on the credit side. What about the capital and liability are same? If they are decreased, we show on the debit side. If we are increased, we show on the credit side. You see? So any accounts, any transaction will be shown on the double entry bookkeeping. This means double entry means debit means credit. This is a double entry bookkeeping. So you must remember these rules. These rules are very important. Later, when we do exercise, you understand more in detail why we do like this, and you have to remind always these rules. Let's see the next one. So the asset of stock. Do you remember the sales? What is actually sales? The sales is the assets, right? Cash sales. This is examples given us. Let's see on the cash sales first. When we have a sale some products by cash. So we show it on the, you see the cash itself we show on the debit side. In the debit side, the cash will decrease because we have a paid for. Just a moment. Sorry. We just have sell some products. In the debit side, we show that the debit side cash that we have received some cash. It will increase the debit. And on the credit side, the sales will decrease. Sales will decrease. Next one, the credit sales. That means if we have sales some products on the credit. So on the debit, we show the debtors. will increase, and the credit side will show the sales. Sales will decrease. Decrease sales. That means the products, the goods go away from the organizations, and we show on the credit that it decreased. Let's see the debtor pays. So this is the cash sales. We have sell some product, and debtor pays us a cash. So we shown the cash. Debtors pays us cash will increase on the debit side, and the debtors will decrease in the credit because we have paid the cash one. And debtor, let's see the debtor returns. This is when we sell on the credit. We have increases in the debit side, the returns inwards, and we have decreases on the credit side of the debtors. So the sales are our assets, right? And in the debit side, there are always increases. You see, we sell the product, the cash increase. Here is when they paid, the cash increase, and in the same when we sell in the credit, also the debtor will increase. That they have a return to us money, and the returns. And when the debtor returns the money, the returns inwards will increase. That means they return the money for any goods for the products. Yes, someone asking me to practice in life. See, we have sales, right? For example, in any trading organization, we have sales. We sell some products. We sell, let's see, we sell the juices, right? We are like some. We have some stock. We sell the juices. When we sell on the cash, we show on the debit side that cash will increase, and the sales we show on the credit will decrease. And same with the credit sales and the cash sales. This is double entry rules always remain same on the sales. Here is given main examples. When we pay by sales, when the customers pay for our products by cash, or when the customer pay for our products by the credit. I mean, they haven't paid by cash. Maybe they have made some bank transactions. So what do you think? Who didn't understand these transactions? Let me know. That's fine, yes, because we are going to move for the next one. You have to understand these transactions, how we do. So next one, we have asset on stock. So we have purchases. This is very things when we buy products. Before we have sell products, we have sell the products. Now when we some organization which buy products. Example. CR means credit and DR means debit. So purchases here is when we buy products. When we buy products by cash, we show the cash on the credit. It will decrease, right? Because we are given the cash for the for any shop, for example, when we purchase. And the purchase we show on the debit side, which is increases. And same with the credit purchase. When we purchase the product not by cash, we purchase by credit. We are given some, we are taking some loans, and we purchase some products. So we show that the purchase will decrease on the debit side, or sorry, increase on the debit side, and on the credit side, our creditors will increase. Creditor means we must to pay for someone, and credit will increase. So when we pay the creditors, when we pay the money for products, for example, we buy the purchases, it means we buy the products, and we pay for any shop. When we buy the products, we pay money, right? We show in the cash that cash will decrease and show in the credit side, and the creditor will increase, we show on the debit side. And we return the goods. When we return the goods, we won't pay the money for the stock or organization or any shop which sell the products, and we return that goods. So here is the debit side. The creditor will increase as we are creditor, and the credit returns our will decrease because we are given the goods goes away from the organizations, and it will be decreased. Here is on credit side. So here is the purchases, the sales are or all our assets. You see assets here is always on the debit side it increases, always on the credit side will decreases. You remember? So these two rules have a relationship. These rules with these transactions. You see, with the sales transactions and with the purchase transactions. So here is just want to give you some in detail understandings, and we will back for the transactions. So the effect of profit and loss. So when we have a revenue, the profit, when revenue means when we sell something, when we have money, right? We have some revenue, and minus expenses will show us the profit, the benefits or loss. So revenue is the income generated from the sales. When we do some business, we sell some products, from the commission received, from the rent received. For example, we have a rent some land or property. So expenses, the costs incurred in generating income. Utilities, for example, we have some stock shops. We use the electricity, water, and so on. We pay for utilities, right? And this is our expenses, the business expenses. Rent, we pay for rent of any stocks, right? And vehicle maintenance, we have some cars, and we pay for petrol and so on. The repairs of the buildings and cars, postage, we have the couriers and so on. And these all are expenses. Here is, I can add also this salary, right? The staff salary also are expenses of the business. So, and when we have revenue minus expenses that we got during the business, show us the profit in the plus or loss in the minus. We will get the benefits or we will lose our money. This is loss. This is a simple, so the effect of double entry. You see, any revenue account in the credit side will increase. If we take expense, they will increase in the debit side. So, like revenue, just give an example. This example, you see revenue. In the debit, we will receive some money, right? The company receives some money, for example, in cash. We show in the debit side, and in the credit side, we show the revenue itself, that it has increased the revenue. What about the expenses? The expenses are always will increase in the debit side, right? This is the same things. And the credit, the cash will decrease because we have to pay some money for utilities, rent, and so on. And this is the double entry rules for revenue and expenses. You should also remember always it remains same. And you have just take in your heart, in your mind, remember these things. So let's move to the next one. So here is given some examples. As you ask me the examples to explain the debit and credit, why it's increase or decrease. Here is double entries for expense and revenue. Here is the, as I told you, the exercises as examples. So rent of 200 is paid in cash. So we are company, we have some stocks, we pay for rent, and we have paid 200 in cash. And the debit side, you see, we are showing the rent. That is rent increased, our rent is increased. In the credit side, we show cash. Cash is decreased, means minus. Decreased means we have paid the cash from the company. And we show on the credit side. Yes, the 200 is, we show on the 200, we show on the right side, cash. Yes, right. Mr. Barak, right. We show the 200 on the cash right side. The next one, the motor expenses of 355 are paid by check. We also show on the right side the bank account that we paid by check, then expenses 355. And in the debit side, we show the increase in motor expenses, that our expense has increased, right? Yes, right. Mr. Barr has given right answers. And next one, the $60 of cash received for commission earned by the business. So here is we received some commission, right? And we show on the commission received, we show on the debit side because we have received cash. Here we show the 60 on the debit side. And in the credit, we show that commission received has increased. So the first one, rent of 200 is paid in cash. The 200 cash we show on the right-hand side. That 200 on credit right side. Next one, the motor expense 355. We show also in the right-hand side. Here is, for example, do you remember this is like this? Here is our debit. Here is our credit, right? And the motor expenses of 355 paid by check. And we show here is we paid by check 355. They are decreased. Here is. And the rent of 200, I'm going to show you. This is the debit side. This is the credit side. It's paid by cash. We show here is Like we lose 200 money, we paid, here is. So, and the last one, the 60 cash received for commission earned by the business. So we received the money. When we receive money, here we show on the debit side, on the left hand side, 6,000. So I hope you can understand my writings. So this is the answer for these questions. Okay, let's go. Next one. So drawings. So the owners will want to take a cash out of the business for their private use. So what about if the owners will want to take the cash from the business for private use? Any money taken out as the drawings will reduce capital, right? Do you remember we already had the same exercise. When the owners take a cash for personal use, it will decrease in the capital. An example, on July 25, the owner takes 100 in cash out of the business for his own use. Drawings means we are going to draw this money from our account. So we show that in the debit drawings 100, and the credit cash it decreased on $400 US. We will check out, yes, and this is you see our $100 US will be decreased in the capital and in the cash. And next one, next example here is on July the owner takes 300 of goods out of the business for his own use. For example, he has taken another 300 in goods, not in cash, but in goods, in products means. So here is, we show the drawings on 300 will increase and purchases, the purchase for 300 also would decrease. Purchases decreases for 300, right? And we show that first we show that the purchase has decreased for 300. We show, and next one we show on the debit that we have draw out that 300 of the goods in the debit side. Yes, and total capital will be decreased for $400 US, right? And this is like, if I can write. Okay, and total the organization's capital will be, the organization's assets will be decreased for $400 US, which 100 equal for cash and 300 US equal for goods. So I think I can see that you do understand this example, that the drawings. That's very good. So balancing of accounts, the stage 1. Let's see, we have a balancing. We have just given the 4 months, how we balance the accounts. The stage 1, you see the stage 1, add amounts on debit and credit side. First we add the amounts on the debit and credit side, as we do here is. And the second stage, take the higher side to deduct the lower side to obtain the balance. And the stage number 3 is the enter balance. We enter the balance here so that the totals will be equal. You see? Stage number 4. Now we enter the totals level with each other. The totals here is 482. We enter with we show the balance with on the left side hand with the right side. And stage number 5, we finally enter the balance to start the off entries for the following month. This is the balance for the following month we have taken. The balancing, this is the balance of accounts, how we do actually in the, how we practice it. And you see the August 1st, we showed the sales for 158. The August 15th shows the sales for 206. And the August 30th sales 118. The total will be 482, right? The total sales for the August will be 482. And right now on the right side we have a bank. We have some loan from the bank for 158, and we have a balance carried down for 324, and total will be 482. This is two figures, shows the equation with the right and left sides. No, expenses, you see the expense would show us here is the stage. Look at the stage number 2. They take the higher side to deduct the lower side to obtain the balance. So if we have here is 482 in sales, right? I'm just going to change my color, show you. We have a sales total 482, and the stage number 2 explains that we take the higher side and deduct that from the lower side, and 482 deduct 158, and it gives us the answer 344, the balance carried down. And the balance carried down, you see the stage number 2. And you see, right, and after that, when we show the balance carried out, after that it shows the equation between this right side and the left side. But anyone in the step number 1, the balance brought down, we show that we have brought down our balance for 324. Finally, the stage number 5 shows they finally entered the balance to start the off entries for the following month. So we show from the following month we start from the 324. It never goes away. It's will continue. We'll check to continue for the next month this amount. Who do understand? Who didn't understand? Please let me know. Because I know that this is not simple things to understand. So here is Mr. Akmal says that he didn't understand. Okay, you see, again I'm going to show you. We have a sales on August 1st, 158. Then we have on August 15 sales 206, and then we have August 30 sales on 118, right? The total will be 482, right? And this is shows the revenue, right? This left side shows our revenue, and right side shows expenses. And then we have the bank loan for 158 for 158, and we balance carried down. Why we have a balance carried down? Because according to stage number 2, we must take the higher side, deduct the lower side. We are taking the higher side 482. We deduct 158, and we are giving the balance carried down for 324, right? We enter in the balance. And later you see the 185 plus 324 will be 482. And here is right now we have a balance equation between left side and right side. But as you remember, we balance carried out down for 324. We show here is we balance brought down for 324, and always is will be moved for the next month. On the next month, we're going to show 324 that has been carried down. This is how we balance the accounts. You must understand that when we do balancing, we have 5 kinds of stages how we do it, because the left side, the credit side, and right side, the debit side, must be always equal. The balance, the assets, expenses must be always equal, have a balance. And when we do not have a balance, some of the higher, some of the lower, we are deducting it. Deducting means we are balancing, we are equating it. So here is some questions. Asking how I create the balance. I just have taken this is a sales, just going to type you the sales, the total sales, just a moment. Total sales, which is 482, and minus the bank 158, which is equal to 324, the balance carried out. So here is so we have a total sales, right? The stage number 2 explains that we should take the higher side, deduct from the lower side. So we're taking the highest. Here is highest is 482 minus the lower side 158, and then we show the balance which is carried down for 324, and this amount will be taken for the next month. For the next month, it's brought down for the next month. So okay, thanks. I hope you do understand. We have another 10 minutes to finish our presentations. So let's move to the next one. What is a trial balance actually? The trial balance is a list of all accounts used, including the corresponding the balances at a specific date. Normally, the trial balance should be prepared at the end of the specific accounting period. And the debit and credit totals need to be equal, right? The debit and credit side, as we shown before in the example, they must be equal. And the main purpose of preparing the trial balance is to ensure that the total debit and credit balances are the same. An equal amount of total balances indicate that errors have happened in any one of the stages in the recording process, whether during the journal entry, posting to ledger, or preparation of the trial balance. So we have a trial balance which shows all the debits and credits, which shows our revenues and expenses, right? And sometimes we have some errors in the trial balance. When we do not have the balance, when we do not have some equation, that means we made some mistakes. We have some errors. So, and that maybe happened during the journal entry, the posting, the ledger, and so on. So let's see those errors, why they could happen. Here you can see given examples of the trial balance. RIN, Payable service, the trial balance accounts. You see, this is just examples of the trial balance. Cash on the debit side, because it's increased, it's our assets, right? Assets. Accounts receivable, we show on the debit side, it's increased. Supplies, we are getting the money. Also, debit side, prepaid insurance, the land. You remember our land, we show on the debit, that is the plus, means increase our capital, increase office equipment, same. What about the accounts payable? This is our expenses, we show on the credit side. Notes payable, the rental, also all our expenses are. The capital RIN, the capital is our capital we show on the credit side. It's not expenses, but our capital we show on the credit side. The drones RINs, the drones we show on the debit side. Service revenue, the revenue we show on the credit side. That is so we always, our assets will show on the debit side, and liability and the capital we show on the credit side. So, and here is our expense like salary, rental, we show on the debit side. They has increased. We have paid for expenses. So, and this is trial balance, shows that the total is 80,200 from the debit side. You see? And the total is 80,200 is the credit side. So this is, which is the credit side, shows our capital and our liabilities. How much money we have, what we have actually. And debit side shows our business we do and expenses we have when we do during the business. Sorry. So have questions. So equipment is assets comes on debit side. Where is the office equipment? Yes, we show on the debit side. Our is because we have paid for that equipment for 3,600, and we show it on the debit side. So how do you understand this trial balance? So accounts payable, here is, that means we must pay for somebody for some service or goods. Accounts payable that we haven't paid yet, but we must pay. But when we haven't paid this money, we show on the like our capital, our liabilities. You see, here is on the credit side. We haven't no, this is accounts payable. It's company's liabilities, right? We show on the credit side that we haven't paid for somebody. Yes, we have to pay and it's payable. So let's move to the next one, because so we have some quick review questions. So let's see. The transaction involving Adeline Enterprise throughout the month of February 2001 are transactions. So let's see. We have here is transactions, and you show the ledger accounts and trial balance for the above. For these transactions, this is your like a homework. Let's see. You must show these transactions how we do on the trial balance, like this example. So take these transactions and put on this trial balance. This is your homework for quick review question. And on the next session, we will check the true answers. So this will be the homework, the quick review question. You see, take these transactions and put on the trial balance correctly. You must identify, for example, purchase office supplies by cash, where we should to put it, on the debit side or on the credit side. Next one, Adeline withdrew cash from the business totaling 2,000 for personal use. Do you remember this is drawings? Where we should put on the debit or credit side, right? This is your homework. So you do on the for the next session, where we will check the true answers. This is homework. So let's move to the next one. We have some errors. Do you remember, as I told you, sometimes the balance would be not equal because we have some mistakes, some errors that will not affect the trial balance to balance. So which errors will not affect the balance? So we have some error of omission. This type of error occurs when the transaction is completely omitted from the books. We just missed our transaction and it missed our books. So error of commission, this occurs when the quarterly amount is entered but in the wrong person's account, right? When we do quarter amount but in wrong person's account, this is error of commission calls. We have some error of principal. This type of error occurs when an item is entered in the wrong class account. For example, we think that it's expensive, but it's not like expensive. It still would be on the assets because we haven't paid the money. This is like error of principle. The compensation error, this occurs where errors cancel each other. Error of original entry, this occurs when the original figure is wrongly calculated. Just mistake when we calculate wrong, like 2 plus 2, not 4 or 5. This is like simple one. So next one, errors of reversal of entries. This type of error occurs where the correct amounts are used, but each item is shown on the wrong side of account. For example, you have shown not on the debit side, like this. For example, we paid for 200. We must show on the credit side, right? But you have mistaken and shown on the debit side. Like, this is errors of reversal of entries. That's also questions. Next session would be for preparation of final accounts and balance sheet. So what any kind of question related to the presentation? So I have some questions. Sorry, please send out the exercise answers in your first presentation. Okay, I will. You wanna the answer for the first presentation, right? Okay, I will. Yes, I will send you these answers for the first presentation, and your homework is trial balance. You remember quick review questions. You must do understand how to balance your transactions, where to put like this the trial balance, to prepare the trial balance for Edlin Enterprise, where to put on debit or credit side, and your debit credit side must be equal. You must have a balance in total. If someone you can do it on the next session, or you can email me if you already will have done this transaction. You can just email to me before the next session. If who didn't understand or cannot do this exercise, we do on the next session. Okay? Yes, I will do everything. Just after this class, we will send you as last time all this presentation with the questions. So okay, and I will send you the someone asking me to send the presentation for the next session to be prepared. We'll send you for the third session. And someone says that suggests that for most of you are not finance, and any help. Yes, as I told you on the first session, you must read yourself that the ebooks that I have given you, that I sent you by email. Do you remember? You must review them, because the classes are not enough to learn about the finance, and to make some exercises, to give some solutions for exercise, you have to learn to review your own in your home, and maybe get some help from your friends who is finance or accounting, or who do know the finance actually, because we have not enough time to learn everything and explain each figure on the sessions. Do you agree with me? So thanks for you. So the class would be end soon. Yes, right, soon. So thanks a lot. I hope you joined the class. I hope you are not confused with the exercise. If you are confused, you can just email to me your questions, and I give you the answer in detail. Who do not understand today's sessions, today's presentation, exercises, all the double entry and so on, just email me your questions, and I try to give you the answer in detail and give you some simple examples to understand. Is it okay for you? Thanks a lot. So I'm going to stop my recording. It already has stopped. So thanks a lot, and goodbye, and see you on the next session.